In many parts of the country, especially in the southeast, it did not rain enough this year for farms. Most farmers just eat the loss and hope next year is better. This one did not have that risk. Here's what happened. Traditional crop insurance has gaps. You have federal crop insurance, covers some perils, but not all. Coverage is tied to documented yield loss. It requires a harvest and measurement. The process can take months. There's adjusters, there's paperwork, there's audits. The dollar payouts often come after the next planting season decision is already made. So you have to buy your seeds and you have to do all your other planning ahead of time. The weather damage that does not destroy the crop but reduces it can fall outside coverage. What can you do about this? Well, you can look at what's called parametric coverage. In agriculture, parametric is a type of insurance that simply has a basic trigger event, so much rainfall, so much heat, and a flat payout. You don't have to prove how much you lost. You don't have to prove how much damage it did to your crops. You just show either too much rain, not enough rain, too much heat, not enough heat. And you can set a window. So you can say if the rainfall is either less than 2 inches or more than 20 inches, then that would prevent the harvest, that would damage the crop, and you insure a flat amount, 200,000, 800,000, whatever amount you want to come up with, and the premium will be based on that. You can do it as just the low end, just drought, defined as rainfall below a certain threshold over a certain period. Let's say from March until June. If it doesn't rain at least 3 inches, then that triggers the policy and you get a flat payout. It doesn't change based on how much it rained or didn't rain. Either it went below that or not. It doesn't change how much coverage you get or how much you get paid if you plant your crops. If you still plant your crops and find ways to get some yield, you still get paid the full amount, even if you were able to recover some of your crop revenue. You can even cover things like temperature. If it gets too hot during that time period, how many days over 80 degrees, how many days over 90 degrees. You can cover freeze. If the temperature goes below a certain threshold, maybe 28 degrees, during growth windows, you can get paid. And it's a flat amount. Even if you're able to recover some of the crops or maybe dig them out real quick and put in another batch, you can still get paid. Hail is something that can damage crops. You can get parametric insurance for hail. Wind sometimes is relevant for things like orchards or certain row crops. Again, it's something that you get paid a flat amount. So how do you set the trigger for a farm? Have a conversation with your underwriter, with your broker, we can do this, about your specific operation. What rainfall total do you need to break even? What temperatures during what weeks could damage a certain crop? You can have the triggers based on certain regional weather station data, satellite data, or even on-site sensors. The insurance company can put on-site measurement on your operation, especially if it's larger, and have that be the trigger. Triggers are precise and crop specific. You may need coverage for corn, but not soybean, or maybe orchard, but not row crops. It can be very, very customized to your operation. How the payment works. When the trigger hits, the rainfall data comes in, it's analyzed, did it meet or exceed that? If not, the payout is processed. Typically 5 to 21 days from the trigger event to funds in your account. There's no yield documentation required. There's no adjuster visits. If your crop did fine, but the trigger still hit, you still get paid. Contract is the contract. Some farms use the predictable cash flow as a financing tool. So if you have this parametric coverage, you can go to your lender and say, look, doesn't matter if I have a crop yield or not, I'm still going to get this cash flow. And this parametric can help you with your financing. The parametric does not cover your federal crop insurance, does not replace your federal crop insurance. It fills gaps. It covers what the federal misses. The combined coverage gives you more comprehensive protection on your operation. Your insurance broker can structure these both together to make sure they mesh well. As an example, mid-sized corn operation, the parametric drought rider on top of the federal crop insurance, the year had below average rainfall, but not catastrophic. The federal payout was limited because it wasn't a catastrophe. The parametric trigger did hit the threshold, so a 6-figure payout happened within 2 weeks. They used that to plant cover crops and to reduce the next year input costs. The operation where the weather variable hurt margins the most in recent years are the ones that need this the most. Specialty crops are not well covered under federal programs. Smaller operations that are under the thresholds for the federal crop insurance need this. Anyone who wants faster, more predictable weather protection can use this, or to supplement what the federal has. Either way, it doesn't hurt. What do you have to lose by looking at it? You can take a look at your cash flow. You can look at previous years to say when the rain was below 2 inches during the planting season or during the growing season. My crops were reduced by $150,000. So let's look at a $150,000 policy with this threshold. Maybe it costs you $1,000 or $2,000. Is that a good return on investment? Because either way, now you know your cash flow is there. It's like an investment or a hedge against your losses. You probably have other hedges you have, maybe for fuel, maybe you buy your seeds in advance, or you commit to your seed purchase with your ag provider. Those are all things that are hedges. You can do the same thing with your crop output to make sure that your revenue is going to be there when you need it for your expenses, for your capital cost, for your next year input costs.